It's a big week for tech companies as Microsoft, Meta, Apple, and Amazon all report their latest earnings. Here to help us talk through all things tech, we've got Bryant VanCronkhite, who is the Allspring Global Investments Senior Portfolio Manager. Great to have you here with us. Okay, so is there one of these tech names that could really kind of be the make or break for the broader earnings season?
Good to be with you today, Brad. I think all of them are incredibly important. There's a tremendous amount of capital that has chased these big AI early winner trades. And right now, investors are worried about two things. They're worried about the slowing of the growth rate, so the second derivative slowing. And they're also worried about the return on investment. Is there going to be enough early return over the next 1, 2, or 3 years to justify these major investments? And investors are listening very carefully for that. I don't think any one name matters at all, but I think those two big themes matter across all those names.
And so the theme that we have seen, at least in earnings seasons past for some of these major tech companies, has been, hey, what the heck are they going to say about generative AI? What do the investments look like? What are the real technological advancements that are going to be put into their customers, whether that be business customers or just consumers who are at their house trying to figure out, okay, what can generative AI do for this recipe that I'm trying to make? All these things considered, that was the theme of earnings season past. What is the theme going forward from here that investors should be paying attention to?
The theme now is how do we make money, right? All these ideas on paper sound great. They sound wonderful. And in theory, they can help drive revenue, help improve margin profiles by reducing costs, but we're not seeing it show up yet. It's time to show me the money when it comes to these AI trades. And my fear as we go up cap is that it's not there. Now, down cap, we're going to start seeing more and more companies begin to talk about that. They're going to start putting real world examples to work here. And I think you might see that AI money move down cap. But the reality is no one's going to be showing you, or very few companies will show you right now that they're actually making money or saving costs in a material way at this point in this AI life cycle.
All right, we love a good Jerry Maguire reference to begin the week, so thank you for that, Brian. You know, as we're thinking further out to some of the broader plays outside of tech that investors perhaps should be keeping close tabs on as well, if there is a rotation, if there is some profit taking that really comes into light right now, where else could that either be put back to work or ultimately investors start to kick the tires on other trades?
Well, I've been calling for this value rotation going back a couple of weeks now, and it's starting to play out, but there could be more legs to this, and it makes a lot of sense. With the amount of money being concentrated in a narrow market, we only get there for one of two reasons. We either get there because of greed or exuberance, which we have today around the AI trade, or you get there out of fear. When you're worried about the overall economy, maybe the Fed being late to react, pushing us into a recession, you want to get more and more capital around a fewer and fewer set of companies where you have the most visibility. So both fear and greed have pushed capital into a narrow market, but those will both get resolved eventually. And I think the cool inflation prints is giving the market the belief the Fed can begin to act, giving them a chance to jump through that ever-closing window to avoid a recession. And as that happens, the natural rotation is out of the concentrated names into the value trade, into the broader markets. That's what we're seeing now. That, I think, will continue, but we need to be aware of what we're buying. You cannot just go out there and buy the lowest quality companies in small cap land, the non-earners. You want to buy companies that are not dependent on a generous Fed, companies that are controlling their own destiny by deploying capital in a wise way, companies that are acting offensively, even if we're going to go into a defensive world.
You know, even as the focus this earnings season, as it is every earnings season, but it seems like more outsized this earnings season, the focus really being about and around net profit margins right now, especially across some of these big tech names who have already talked about the big investments that they're making for their businesses to really spur that next leg of growth. You know, as you're thinking about securitizing some of those margins, where do you expect these big tech companies to be able to lean or pull a lever in order to show investors that they have other areas where they can drum up profit in the face of a consumer that seems battle weary right now, at least?
Yeah, I think anytime you worry about a slowing top line, if we're going to go into a slowing overall economic environment, which is plausible, maybe probable at this point in time, companies need to show other levers. And so one of the best places to show is in your margins. But you're going to have deleveraging as top lines fall because your fixed costs aren't changing materially. So what can we do on the variable cost side? And a lot of that will have to come through labor. And here's where things get a little dicey for the overall market. If companies need to start pulling the lever of reducing labor, unemployment will rise, and that's going to cause concern across the broader market. So my view on this, to answer your question, is they're going to start pulling back on labor, which is going to push unemployment higher, which is going to suggest the Fed has missed their window, and ultimately we're going to push into recession. That's the biggest concern. Now, on the other side of that, labor costs are beginning to come down, so the inflation in labor is dropping. Some of the chemicals, some of the materials, some of the metals are dropping. So some of the cost of goods sold in industrials and materials could be improving. So there's other ways to play that. But the most direct way that companies have, unfortunately, is reducing headcount, which is going to put pretty much a significant concern into the broader markets.
All right, we'd certainly be watching for any kind of concerted announcements around headcount reduction over the course of this earnings season, especially from those tech companies, as we know you will be as well. Bryant VanCronkhite, who is the Allspring Global Investments Senior Portfolio Manager, great to have you here with us on the show.